Are you tired of all the volatility in the stock market? Boy, I feel your pain. And this video is for you. In this video, we will discuss 3 key things that will help you recover your losses and make you a better investor in 2022, whether you're investing in stocks, ETFs, or mutual funds. So stay tuned. Hey, welcome back. It's Phil from Build My ROI, where we empower you with the mindset and financial skills that you need to build and grow your wealth. My goal for this channel is to share what I've learned working professionally in finance as an investor over 15 years and break down financial and investing concepts into simple language while giving it to you straight without the hype. Please note that the content I share here is educational information and should not be construed as financial advice. So please consult your investment advisor because everyone's situation and risk tolerance is unique. Finally, if you're new here, make sure you click that subscribe button and like and share this video if you find value in our content. With that out of the way, let's get it. We've all seen the headlines and felt the pain. It's been ugly in the market as we've seen stock after stock keep falling. It's official. We're in a correction, ladies and gentlemen. So the bubbles in many parts of the market have burst, and the momentum investing we saw in 2020 and 2021 is long gone. 2022 is a totally different investing environment. In today's market, momentum investing has been replaced by an environment where fundamentals and macro drivers are reasserting themselves in stock prices. In other words, this has become a stock picker's market. Let me explain. 2 important things one needs to pay attention to and that now drive stock prices are first, macro drivers. And this refers to macroeconomic factors, for example, what's happening with inflation or what the Fed is doing. These macro factors affect companies that operate in different sectors differently. High interest rates, for example, will result in a slowing down of the economy as a result of lower business and consumer spending. High interest rates affect most stocks negatively because there's an anticipation that demand and consumption will slow down. However, financial stocks, like banks, are an exception to this, since interest rates actually benefit banks because they'll lend at higher rate, which would be obviously a positive for banking stocks. Similar to interest rates, inflation is another macro driver that will affect stocks. One of the tools that the Fed Reserve uses to manage inflation is the Fed funds rate, which is the basis of interest rates in the economy. If you guys want to learn more about the Fed and its role in the economy and impact on markets, just drop me a comment below and I'll be happy to do that. The second factor to pay attention to is company fundamentals, which refers to a company's specific performance metrics. So for example, what is the company's valuation or valuation multiple? Is the company profitable and does it actually have earnings? Do its reported quarterly earnings meet Wall Street expectations as well as what Wall Street calls earnings guidance? How much free cash flow is it generating? These company-specific factors have now come into focus as institutional investors who control the largest pools of money in the stock market generally value companies on the basis of cash flow and not just growth. These 2 factors, macro factors and fundamentals, among other things like geopolitics, like we've been seeing with the situation in Ukraine recently, are now the basis on which stocks are trading and really driving what's called price discovery. In other words, investing has become a lot more involving than most retail investors are used to. So whether you're investing in stocks or ETFs or mutual funds, the following 3 tips are going to help you navigate this more complex environment. So listen up. And if you stick around, at the end of this video, I'll share an additional bonus tip that you can add to your investing toolbox. All right, let's dive in. Number 1, your investment thesis and investment discipline. Whether you're investing in stocks, mutual funds, or ETFs, you need to understand why you're making a particular investment, your time horizon, and whether it fits your risk tolerance. Think of your investment thesis as the rationale or the why of an investment decision. The investment thesis will help clarify when it makes sense to invest, when to add to a holding, and even when to trim or sell out of an investment. There are several things to consider. However, 3 of the most important are first, again, the macro environment in which the company is operating for a stock, ETF, or mutual fund. the company's profitability and the cash flow it's generating, and lastly, the valuation multiple that the stock is trading relative to its peers and relative to the market. So these are some of the inputs that Wall Street uses to evaluate stocks. The key here is to do so in a disciplined manner for each investment that you're making or that you hold. Most importantly, always keep this in mind, that discipline trumps conviction. This is a topic that deserves its own video, so leave a comment below if you'd like me to make a separate video on how to come up with an investment thesis. If you're finding value in this video, please click the like button, subscribe, and share this video to support our channel and mission of financial and investment education for all. Number 2, diversify. So diversification is the only free lunch in investing and finance. What does diversification mean? Simply put, you should be investing across a broad number of stocks and doing so in generally uncorrelated sectors. That's the key to minimize your downside during different points in the market cycle. When you buy or sell, always ask yourself this one question: is this investment making me more diversified or less diversified? This is the single best way to minimize volatility in your portfolio. This is achievable through investing in ETFs or index funds, or by owning a basket of stocks that have a low correlation, meaning that they are in unrelated sectors. Owning gold through an ETF or a gold miner stock, for example, also helps with diversification during downturns. You might be wondering if crypto is an alternative to gold or a portfolio hedge. I think the jury is still out on that, as we've seen crypto get negatively impacted when growth stocks get hit. If you guys want me to do a video that covers crypto, just leave me a comment below and be happy to. So you might also be asking, as an investor in stocks, how many stocks do you really need in your portfolio to be well diversified? In finance theory, you'll learn that the number is 32. And so the rough rule of thumb is basically between 30 and 40 stocks. This is based on work published in a research paper in the 1970s by Lawrence Fisher and James Lowry, looking at the variability of returns in a stock portfolio. I've put a link in the description below for those who want to learn more about this research. For most people, those investing in funds, diversification is easily achievable by investing in ETFs or mutual funds or index funds. This brings us to the third tip: buy dividend stocks. Owning dividend yielding stocks is the equivalent to having your cake and eating it too in investing. So admittedly, dividend stocks are not the sexiest stocks to talk about, but one thing that is a fact is they're absolutely clutch when it comes to performance and returns. This has been proven time and time again over many market cycles. Generally speaking, the companies that are consistent dividend payers are more mature businesses that have a stable outlook on their earnings and free cash flow, through which they pay out dividends to their shareholders. There's a lot of great research which backs why dividend stocks should be a mainstay of any performing portfolio in the long term. This is not just territory for retirees or retirement accounts. These stocks provide returns from both stock appreciation and yield or income. This is achieved because of two factors: the power of compounding, where dividends are reinvested continuously, and secondly, the yield of these stocks lowers their volatility because of the steady cash flow from the dividends. What's the evidence of this? Well, research by Hartford and Morningstar, amongst tons of other research, shows that going back to 1970, 84% of the total return of the S&P can be attributed to reinvested dividends and the power of compounding. This is a game changer, ladies and gentlemen, because it works across market cycles. I've included a link to the research in the description box below for those of you who are interested in learning more. The key here is picking the right dividend stocks or funds. Here you want to look for dividend stocks or funds that first have consistently paid sustainable yields, which means that yields haven't fluctuated significantly over long periods of time. And secondly, you want to make sure that you're picking stocks that have historically grown their dividends at or above the inflation rate over time. And one more thing on dividends stocks or funds: consider investing in these out of a tax-advantaged retirement account like an IRA or 401k. And now for the bonus tip: scale into your positions. It's important to stay invested in a market like this, like the one we're in, as painful as it is. And you should view this time as an opportunity to rebalance and diversify your portfolio. As we said, first figure out what your long-term goals are for a stock, ETF, or fund, and what your investment thesis is. And because you cannot time the market, the smart thing to do is to build a position in those funds or stocks that fit within your investment thesis by buying periodically, say weekly or every few weeks. Don't buy the dip just because the stock looks cheap. That's a trap, and that can be a painful mistake. Instead, space out your purchases based on your predetermined entry points. Similarly, when you're looking to exit a position, figure out ahead of time what those exit points are so you can pull the trigger at that particular time. So let me give you an example. Let's say you want to invest $1,000 in Apple, which is trading at say 160 bucks, down from a market high of 183. This is an attractive entry point, and what you would do here is you would invest say 1/3 of your $1,000, say 320 bucks, or the equivalent of 2 shares at this current price. You then wait and see how that position performs. And once the stock falls to a level that you're happy with, say after a couple of weeks, you'd buy another 2 shares, which is equivalent to another $300. Give it another couple of weeks and then buy the last sort of lot or tranche of your initial purchase amount, which is another $300, which would round out to roughly another 2 or 3 shares, depending on where the stock price is. You could also automate this process by using limit orders at preset prices. So that's another more sophisticated way to do the same thing. This approach works on the way down and is a form of what we call dollar cost averaging. By breaking down this position essentially into 3, you're minimizing your exposure or risk each time you buy. The benefit of this patient approach is you're buying at entry prices while waiting and watching what the market is actually doing. Scaling into a position also works on the way up, especially in the early stages of a market rally or as a stock or ETF starts to gain momentum. This approach is also useful as you sell out of positions. So don't forget to use it. Scale into or out of your positions. Well, that's a wrap. We made it to the end of the video. Please like, share, and subscribe if you enjoyed this content or learned something from it. I'm working on more videos and more content, so do leave a comment if there's any particular topic in personal finance or investing that you'd like me to cover. I really enjoyed doing this for you, and thank you for watching, and until next time, peace and love.